What if you could profit from real estate without ever dealing with tenants, toilets, or repairs? Today, I want to show you a strategy that most investors never even consider: buying and selling real estate notes. When done correctly, this strategy lets you step out the landlord role entirely and step into the role of the bank. My name is Rucker. I'm a Texas real estate attorney, and I've helped investors structure note transactions that generate passive income, acquire properties, and build serious wealth, all without ever swinging a hammer. Let's talk about how it works. The landlord versus the lender. Most real estate investors think of themselves as landlords. They own a building, they manage tenants, and they deal with maintenance, vacancies, and late night calls about broken pipes. But there's another way to participate in real estate: as the lender. As the lender, you don't own the building, you own the financing, you own the debt. When a bank makes a mortgage loan, it doesn't care if the furnace breaks, it doesn't care if a tenant moves out. It just collects its checks every month. That's the lender's life. And here's the key insight: you don't need to be a bank to be the lender. Private individuals can buy and sell real estate notes, and when you do, you're effectively becoming the bank. What is a note, and why does it matter? To understand how this works, you need to understand two key documents. First, the promissory note. This is the borrower's promise to pay. Under Texas Business and Commerce Code, a properly drafted promissory note is a negotiable instrument, meaning it can be sold, transferred, and assigned just like any other financial asset. This is a legal obligation to repay. Second, the deed of trust. This is a security instrument. It attaches to the note to a specific piece of real property. If the borrower stops paying, the deed of trust gives the note holder the right to foreclose on that property. Put them together, note plus deed of trust, and you have what the bank has. You become the bank. You don't need to originate the loans, and you can buy any existing note from someone else who already did the work. Two ways to win as a note buyer. Once you understand what a note is, the next question is, why would you want one? There are two distinct strategies, and they appeal to very different types of investors. Strategy A is the passive income. You buy a performing note, meaning the borrower is current on payments, and you collect the monthly payments for the life of the loan. You earn interest. You earn a predictable income stream. You have zero maintenance obligations. This is the classic become the bank strategy. You need to clip your coupon, you cash your check, and you sleep at night. Well, then there's strategy B. You buy a non-performing note, meaning the borrower has stopped paying at a steep discount. Your goal isn't to get the borrower paying again. Your goal is to acquire the property through foreclosure process. You buy the debt, you foreclose, and you end up with the real estate, often at a price far below market value. This is an aggressive strategy used by sophisticated investors who want to acquire properties at a discount. And I would caution any investor who's willing to go the route of strategy B that there can involve a lot of litigation, cost, and major ethical concerns. The buy process. So, how do you actually buy a note? Let me walk you through the process. One, you need to reach an agreement in principle with the seller on price and basic terms. Two, there's an investigation period. This is your due diligence window. You review the documents, you inspect the property, and you verify everything. Three is the cure period. If you identify problems during your due diligence, the seller may have time to fix them. Four, negotiation. Price adjustments may be made based on what due diligence revealed. And finally, there's the closing. You execute the assignment documents, the note is endorsed to you, and you record the transfer. Due diligence, validity, and enforceability. Due diligence is where most deals live or die. There are two categories: due diligence on the note itself and due diligence on the property. For the note, you're checking five things. I call them the 5 M's. Money: is the stated loan amount accurate? Does the math check out? And now let's look at the math. Are the interest rates, payment schedule, and amortization correct? Signatures: did the right people sign? Were they legally authorized to do so? History: what are the payment records? Is there a performing or non-performing loan? And cleanness: Is the note free of any defects, modifications, or competing claims? If any of these elements are compromised, the note may be unenforceable, and an unenforceable note is worthless. This is why you need an attorney reviewing these documents before you close. Due diligence, the property. You also need to investigate the collateral, the real property that secures the note. 3 questions to consider. Does it exist and what is it worth? You need an appraisal or a BPO, which is a broker priced opinion, to confirm the property's current market value. Is it owner occupied or renter occupied? This affects your legal strategy in a default scenario. Owner occupied properties in Texas have additional protections under the homestead laws. Are the property taxes current? Delinquent taxes become a superior lien to your deed of trust. You could foreclose and find yourself owing thousands in back taxes. The note is only as good as the collateral. A note secured by a worthless or tax burdened property is not the asset you think it is. As is versus guarantees. When you buy a note, understand what the seller is and is not promising. In a standard note sale, the seller assigns the note as is, with no representations or warranties about the note's enforceability or the borrower's creditworthiness. The seller is basically saying, this is what I have, take it or leave it. However, a buyer can negotiate for certain guarantees, what attorneys call warranties. The seller might warrant that the note is genuine, that they have good title to it, and that they haven't done anything to impair it. Texas Business and Commerce Code governs what transfers warranties. When a note is transferred for value, the transfer makes certain implied warranties, including that the instrument is authentic and they have good title. Know these statutory protections and know when they're waiving them. Recourse options. Another key concept is recourse. What happens if the note turns out to be defective after closing? No recourse. The seller has zero liability after closing. You own the problem. This is the riskiest option for the buyer. And then there's full recourse. The seller is fully liable if the note turns out to be defective. Best for the buyer, but sellers rarely agree to this. And then there's limited recourse. A negotiated middle ground, seller liability is capped at a specific dollar amount or limited to certain representations. In practice, most private note sales are no recourse or limited recourse. This is why due diligence is non-negotiable. Once you close, you own what you bought. Sealing the deal. Closing a note purchase involves 3 critical steps. There's the assignment of contract, a written agreement that transfers the note from seller to buyer. This document should be carefully drafted to capture the terms of the sale, including any type of warranties, recourse provisions, and representations. Endorsement. The promissory note itself must be physically endorsed, and that's signed over to you, the buyer. This is like endorsing a check. And a longi, a separate page attached to the note, can be used when there's no room on the note itself for additional signatures. Recording. The assignment of the deed of trust must be recorded in the real property records of the county where the property is located. This puts the world on notice that you are now the lien holder. All 3 steps are essential. Miss the endorsement and you may not be a holder in due course. Miss the recording and a subsequent purchaser could have priority over you. Your next steps. Becoming a note investor is not something you should attempt without education and legal guidance. Here's how I recommend getting started. You need to educate yourself. Read about note investing, understanding the difference between performing and non-performing notes, and study Texas foreclosure law. Enlist professionals. You need an attorney to review your assignment documents, an appraiser or title company to verify the property, and a CPA who understands note investing. Inspect before you invest. Never skip due diligence. A discounted note is only a good deal if the underlying loan is valid and the collateral is worth something. Start small. Do your first deal with modest exposure and learn the process before you scale. Remember, on one side of the transaction is a landlord. On the other side is the banker. You need to choose which side you want to be on. If you're interested in note investing or buying real estate notes in Texas, reach out to my office Every deal is different, and having the right legal structure makes all the difference. Hit subscribe, drop your questions in the comments below, and I'll see you on the next video.